All right, welcome to this explainer. If you've been tracking the financial markets lately, you already know that central banks around the world are basically walking a high wire right now. Today, we're zeroing in on the Reserve Bank of India to see exactly how Governor Sanjay Malhara and the Monetary Policy Committee are navigating some seriously volatile global crosswinds while trying to keep domestic growth chugging along. We're going to break down their exact strategies using the data straight from their latest address. So here's our roadmap for today. We'll start with the big rate decisions, unpack the inflation and GDP forecasts, look at those external risks, and finally touch on some new consumer banking measures.
Let's kick things off with Section 1, the big rate decision, getting right to the bottom line up front.
The Monetary Policy Committee voted unanimously, everyone agreed, to keep the primary policy repo rate completely unchanged at 5.25%. After crunching the numbers on our evolving macroeconomic setup, they decided to just hold steady. And remember, this is the foundational number. It literally ripples through the entire economy, impacting everything from massive corporate borrowing right down to your own personal loan rates.
Moving right in lockstep with that, the standing deposit facility rate sits perfectly steady at 5%. This is the critical mechanism the central bank uses to mop up excess liquidity from the financial system.
And to round out our rapid-fire numbers, the marginal standing facility and the bank rate are both holding firm at 5.5%. This consistency across all three key rates, it paints a picture of a central bank choosing watchful patience over any abrupt knee-jerk reactions. But of course, the rates alone only tell half the story. The RBI also opted to maintain what they call a neutral stance. Basically, this means they're keeping their options wide open as new data rolls in. Instead of locking themselves into a strict cycle of hiking or cutting rates, a neutral stance gives the MPC ultimate flexibility. They literally stated they need more clarity, especially on where inflation is heading before making any sudden moves. They're waiting to see how the growth and inflation dynamics actually play out before tilting the scales one way or the other. Which brings us right to Section 2, inflation and price stability, heavily driven by food and fuel factors. Now, looking at the inflation trajectory, there's a real anomaly here. A projected spike in Q3, surging up to 5.9%. But the RBI isn't caught off guard by this at all. They attribute this directly to supply-side pressures from, you guessed it, volatile food and fuel prices. So, rather than the core economy fundamentally overheating, it's really just a temporary bump before things are expected to settle back down to a 5% average for the entire financial year.
And to prove that point, core inflation remains totally benign. Core inflation, by the way, strips out those crazy food and fuel numbers, and it's projected at a very moderate 4.3% for the year. This is absolutely crucial. It tells us that price pressures aren't becoming broad-based across the whole economy. The underlying cost of everyday goods and services is actually behaving itself, aligning beautifully with the central bank's targets.
All right, let's flip the coin and look at Section 3, India's GDP growth outlook and the resilience of domestic demand. Despite a pretty hazy global environment, real GDP projections are forecasting a highly resilient 6.7% overall growth for the year. After a super strong 7% kickoff in Q1, the economy is expected to just coast in a steady mid-6% range. Actually, scratch that. This overall projection is slightly higher than their previous estimates. The economy is genuinely overperforming against expectations right now.
So, what's driving this? Well, robust government spending, strong domestic demand, and rebounding exports officially keep India positioned as the world's fastest-growing major economy. We are seeing sustained expansion in manufacturing and services. People are out there spending money. Investment activity is incredibly steady, thanks in large part to a massive government push on infrastructure, and we're seeing a double-digit rebound in merchandise exports. It is a remarkably strong domestic picture. But it's not all smooth sailing. Let's move to Section 4, navigating global economic risks in a hazy and volatile environment. When we look at the external sector, it's a fascinating mixed bag. On one hand, India's merchandise trade deficit widened to roughly $86 billion in Q1, driven heavily by our need to import crude oil and electronics. But completely counterbalancing that deficit is a massive wave of global investor confidence. Gross FDI inflows surged to $30.7 billion. Global investors see India's resilient domestic demand, and they are putting their money to work here, ensuring our balance of payments registers a very healthy surplus. However, the RBI flagged several serious downside risks. We've got the evolving conflict in West Asia, disrupting supply chains and causing energy prices to bounce around.
Domestically, uneven southwest monsoons and El Nino conditions are clouding the agricultural outlook. Because, as if predicting inflation wasn't hard enough, now central bankers have to play meteorologists too. Add in persistent trade policy uncertainties, including fresh U.S. tariffs, and you can see exactly why they're maintaining that neutral stance. It is a highly volatile environment out there.
Finally, let's zoom in from the macro level for Section 5, Banking and Consumer Measures, focusing on transparency and sector strengthening. The RBI announced a few very targeted micro-regulatory measures. They're issuing draft guidelines to resume licensing for urban cooperative banks, and they're revising the credit monitoring arrangement for rural cooperative banks. But perhaps the real game changer for the everyday borrower is this last one, harmonizing the regulatory framework on interest rates for advances across all entities. Basically, they're forcing greater transparency in lending rates, making absolutely sure consumers are fully protected and know exactly what they are signing up for when they take out a loan.
Governor Sanjay Malhotra ended his address with a resolute statement. He said, "Whether it is preserving stability of prices, the financial system, or the currency, we will do whatever it takes to ensure the same." The underlying message here is pure fortification. The pillars of the Indian economy are strong, but the central bank is deeply aware of the global volatility knocking at the door, and they're ready to use every tool in their belt to keep things completely stable.
So I want to leave you with this question. With the RBI balancing robust domestic growth against volatile global supply chains, how might these macroeconomic shifts impact your own financial planning this year? If the central bank is actively preparing for supply chain disruptions while keeping rates steady, how should you be positioning your own investments, savings, or business expansions? It's a fascinating time in the global economy, and understanding this data is your first step toward building resilience. Thanks for joining me for this explainer, and definitely keep these insights in mind as the financial year unfolds.